Click the bell icon to get latest videos from Ekeeda.
Hello friends, when new partner is admitted, partners may decide to adjust their new firm's capital in their profit sharing ratio. In such case, if any excess or deficit arises in capital account of partners, it can be adjusted through current accounts. This we are going to study in this particular problem. Let us go through the problem. Manav and Satish are equal partners. Equal means ratio is 1:1. In a business, their balance sheet stood as under. Asset side, cash in hand. This will be opening balance of cash bank account. Sundry debtors, bills receivable, machinery, building. On liability side, we have creditors. We have general reserve. General reserve is accumulated profit. This will be divided between old partners in their old ratio 1:1. Amount of general reserve is 18,000. Here Manav gets 9,000 and Satish gets 9,000. Capital account of Manav, Satish. This will be credited to their capital accounts. Capital account credit. They decided to admit Ajit as new partner on 1st April 2013 on following terms. So your new partner is Ajit. Machinery and building to be depreciated by 10%. Machinery current value is 24,000. 10% means 2,400. This will be deducted from machinery on asset side. Second effect, revaluation account debit or profit and loss adjustment account debit. Building to be depreciated by 10%, that is 5,700. We'll have to reduce building by 5,700. Second effect, revaluation account debit. RDD is to be increased by 1,500. Current RDD is 1,000. So we'll have to add 1,500 here to the RDD. So 1,500 plus 1,000, our total RDD will become 2,500. Here actual adjustment is there only for 1,500. 1,500 will have to record to the debit of revaluation account. Second effect, we are required to add 1,500 to the amount of RDD. Bill receivables are taken over by Manav at a discount of 10%. This is asset taken by partner. Bill receivable are of 12,000. These are taken by Manav. So from bill receivable we have to deduct full amount of 12,000 because new balance sheet will not show bills receivable. It is taken by Manav at a discount of 10%. 10% of 12,000. It comes to 1,200. So 1,200 is a loss that will be debited to revaluation account. 12,000 minus 1,200. 10,800 will be the value at which Manav has taken the bills. So Manav account will be debited for 10,800. Ajit should bring 40,000 as capital for 1/4 share in future profit. This is a capital brought by new partner. Cash account will be debited. Ajit's capital account will be credited. Goodwill should be raised in the books at rupees 25,000. So new partner is not bringing cash for his share of goodwill. So firm's goodwill is raised for 25,000. Here goodwill account will be debited. Old partner's capital account will be credited. That is Mano 12,500, Satish 12,500. The capital account of all the partners be adjusted in proportion of new profit sharing ratio by opening current account of partners. So we are required to adjust all partners' capital in their new profit sharing ratio, and if any difference arises in capital account, it will be transferred to partners' current account. Prepare profit and loss adjustment account, that is revaluation account, capital account of partners, and new balance sheet of the firm. Apart from this, we will be opening cash account and goodwill account to understand the effects in a better way. Let us draw necessary accounts. Let us first find out new profit sharing ratio of the firm. New profit sharing ratio. First step is we are required to find balance of 1. How we can find out balance of 1? That is 1 minus new partner's share. From number 1, we will minus Ajit's share 1/4. That is 1 minus 1/4 is equal to 3/4. 3/4 is balance of 1. Step 2. New share of old partners. We can find out by multiplying balance of 1 and old share of old partners. Manav, balance of 1, 3/4. His old share is 1/2 because they are equal partners. So it comes to 3/8. In case of Satish also, we are getting 3/8. So Manav 3/8, Satish 3/8, and Ajit's share is 1/4. After simplifying this, we get 3:3:2. That is, out of 8 shares of profit, 3 are given to Manav. Out of 8, 3 are given to Satish. So balance 2 will be given to Ajit. We can also calculate least common factor and we can get these values. That is, new profit sharing ratio is 3:3:2. That is 3/8 is to 3/8 is to 2/8. Let us calculate now new capitals of old partners. New firm's capital we can calculate by using formula capital brought by new partner multiplied by reciprocal of his share, his profit share. Here Ajit's new capital is 40,000. His share is 1/4. Reciprocal of his profit share is 4/1. 40,000 multiplied by 4. His capital, firm's capital comes to 1,60,000. So new firm's total capital is 1,60,000. This new capital will be divided among all partners in their profit sharing ratio. Accordingly, we can calculate Manav's new capital, firm's capital multiplied by his new share. Manav's new share is 3/8. So 1,60,000 multiplied by 3/8. We get Manav's new capital 60,000. Satish new capital also we get with same calculation. We are getting amount 60,000. So Manav's capital 60,000, Satish capital 60,000, and new partner Ajit's capital is 40,000. 60,000 plus 60,000 plus 40,000. It is a total of firm's capital 1,60,000. Let us start with liability side. First we have sundry creditors 90,000. There is no adjustment on creditors. So this amount will be directly posted in new balance sheet on liability side. New balance sheet liability side, sundry creditors 90,000. Next we have general reserve 18,000. This will be divided among all partners in their profit sharing ratio, that is equal. Manav will get 9,000, Satish will get 9,000. Partners capital account credit by general reserve account. Manav 9,000, Satish 9,000. Capital account of Manav and Satish 45,000 and 30,000. This will be credited to their capital accounts. Partners capital account credit by balance brought down. Manav 45,000, Satish 30,000. Let us move to asset side. Cash in hand 60,000. This will be recorded as opening balance in cash account. Cash account debit side to balance brought down amount is 60,000. Next we have sundry debtors. There is adjustment on RDD. Asset side debtors 31,000 less RDD opening balance 1,000. Bills receivable there is adjustment 12,000. Asset side bills receivable 12,000. Machinery 24,000. Asset side machinery 24,000. Building 57,000. Building 57,000. We have transferred all items from balance sheet. Let us do now adjustments. Machinery and building to be depreciated by 10%. This will have one effect. On asset side, we are required to reduce machinery and building by 10%. 24,000 minus 10% depreciation 2,400. Now net value of machinery is 21,600. Building 57,000 less 10% that is 5,700. Now value is 51,300. These depreciations will be debiting to profit and loss adjustment account. Revaluation account debit to machinery 2,400 to building 5,700. RDD to be increased by 1,500. This 1,500 will be first debited to revaluation account. Revaluation account debit to RDD 1,500. This will have another effect in balance sheet. Here already we have RDD 1,000. It will be increased by 1,500. So total RDD will be now 2,500. So debtors 31,000 less RDD 2,500. It will be 28,500, that is net debtors. Bill receivable are taken over by Manav at a discount of 10%. Bill receivable are 12,000. Discount amount will be 1,200. This will be debited to revaluation account. Revaluation account debit to bills receivable discount amount 1,200. Partners capital account debit Manav column to bills receivable 10,800. Balance sheet asset side third effect bills receivable 12,000 less taken by Manav 12,000. So now there will be no bills receivable in new balance sheet. Ajit to bring 40,000 as capital. Cash account will be debited and Ajit's capital account will be credited. Partners capital Ajit credit by cash 40,000. Cash account debit side to Ajit's capital account 40,000. Goodwill should be raised in the books at rupees 25,000. So goodwill account will be debited and old partner's capital account will be credited. Goodwill account debit to Manav's capital 12,500 to Satish capital 12,500. Partner's capital account credit by goodwill account Manav 12,500, Satish 12,500. We have given effect to all adjustments. Let us close required accounts. First we will be closing revaluation account. Revaluation account is also called profit and loss adjustment account. Revaluation account is closed. It is showing a loss of 10,800. This loss will be divided among all partners in profit sharing ratio. Manav 5,400, Satish 5,400. Partners capital account debit to profit and loss adjustment account. This is transfer of loss. Manav's column 5,400, Satish 5,400. Let us close now cash account. Cash account credit side by balance carried down 1 lakh. This amount will be transferred to balance sheet on asset side. Asset side we have cash 1 lakh. Let us close goodwill account. Goodwill account credit side by balance carried down 25,000. This will be transferred to new balance sheet asset side. Here goodwill is only raised, not written off. Therefore it will appear in new balance sheet goodwill 25,000. As per our working note, for adjusting the partner's capital, we have calculated new capitals of old partners. We have calculated new ratio. We got 3:3:2. We got new firm's capital by multiplying new partner's capital with reciprocal of each share, that is 1,60,000. Thereby we got Manav's new capital 60,000, Satish new capital 60,000 and Ajit's capital 40,000. These new capitals will be recording in partner's capital account on debit side as to balance carried down. So as per working note, new capitals of the firm will be Manav 60,000, Satish 60,000 and Ajit 40,000. This will be transferred to new balance sheet on liability side. Capital account of partners Manav 60,000, Satish 60,000, Ajit 40,000. Now let us close partners capital accounts. We have closed partners capital account. On credit side we are getting balancing figure for Manav 9,700 and in case of Satish 13,900. These will be transferred to their current accounts. Now partners capital accounts are also closed. These balances of current account will be transferred to new balance sheet. Here they are appearing on right hand side. In new balance sheet also it will appear on right hand side, that is on asset side. If we get current account balance here on debit side, that is at left hand side, in balance sheet we will be transferring it to liability side. We have closed balance sheet. We got total of assets 2,50,000, which is equal to total of liabilities 2,50,000. This means our balance sheet is tallied. In this question we learn how to adjust partners capital in new profit sharing ratio by transferring the difference to partners current account. Thanks for watching this video. Stay tuned with Ekeeda. Subscribe to our channel Ekeeda. Thank you.